If you're earning $150,000 per year and you're only maxing out a 401k, you are missing so much money. We're talking significant financial gains. Today, I'm going to reveal my exact investment hierarchy that took me from maxing out my 401k to building a multi-million-dollar portfolio. And this includes 3 strategies that your financial advisor might not be telling you. The first problem is that you're a high earner, and high earners have a dilemma. They make more money, and their grandma told them to invest in a 401k because that's the right move. At least my grandma did. But my grandma's not a CPA, and my grandma doesn't know taxes. So I questioned grandma, and I realized that investing $23,500 in a 401k every single year, which is the max potential in 2025, may not always be the best use of your money. So here's what the wealthy actually do. The investment hierarchy is really easy. Let me break it down. The first thing you want to do is calculate your savings rate. So take the total amount of savings and investment dollars that you have on an annual basis and divide that by your total income. That's your savings rate. And if this is below 15%, my framework at the 15% mark will end your journey for right now. If you're over that 15%, which you should be, especially if you're in Budget Dog Academy, and if you're not, go in the show notes below and level up your life right now because you will be way over that savings rate. Then we'll continue with the framework after the 15%. The first thing you want to do after you have your actual savings rate calculated is, secondly, calculate 15% of your gross income on top of that. So for this example, let's assume that you have a 20% savings rate in total. You're making $100,000, you save $20,000 or invest $20,000 in total per year. And let's say you have a 3% 401k match. So here are the steps, step by step. Step number 1, contribute to your 401k up to the employer match. So in this situation, $100,000 salary, you're going to contribute $3,000 to that. That's step 1. Step number 2 is you want to utilize a Roth IRA or even a backdoor Roth IRA if needed. So this would be $7,000 in 2025. And step 3, you want to fully max out your 401k up to, but in this situation, $5,000. So I'm already incorporating a second account in this situation to begin. And that would be $15,000 in total. However, we're talking a 20% savings rate here, so we want to take it a step further with the framework. The next step would be to maximize your HSA. You have to enjoy the triple tax advantage. It's next level. So for single individuals, this might be $4,300. And for family, this might be $8,550 per year. And again, these are 2025 contribution limits. Adjust to the year that you're watching this. And after that, anything over and above those first 4 steps needs to go to a taxable brokerage. This is your flexibility fund. This is where the tax game is not really explained to a lot of people, and people think these are tax inefficient, when in fact, these are extremely tax efficient if you understand the game, which I'm going to show you here shortly. So we want to move beyond the 401k and talk about additional adds to your portfolio in your life that are going to benefit you in a major way. Because remember, this is what the wealthy people do. So the first thing is tax efficient fund placement. You'll see the graphic on the screen, and this graphic is phenomenal. This is going to show you from least to most tax efficient on the right side of the types of assets that you could potentially use in your investment accounts. And on the left side, it tells you, based on the tax efficiency of those assets, where to actually place these assets. And as you can see on the screen, we aren't just talking about 401ks here. We're talking about 401ks, IRAs, as well as taxable accounts. And I'll give you a really common example that trips a lot of people up. As you can see, the REITs are one of the most least tax efficient vehicles. And these are real estate investment trusts that a lot of people use in their portfolio. And typically, they put these by default into a taxable account because they know no better. But I always explain, when you have a REIT, because these are tax inefficient and these are taxed at your ordinary income tax rate, there is no reason to put this in a taxable brokerage account, and there's a lot of reason to put this in a retirement account, as you can see on the screen. And so assume your tax rate is 28%. That alone is a 28% tax savings just by knowing more. So the more you know, the better you do. The faster you grow and the wealthier you get. The second benefit that wealthy individuals use is tax loss harvesting. Now, I did an entire video breakdown on this, so go in the top right-hand show notes. Just click on this video and watch this directly after this. I don't want to go in a full breakdown because I have a video designed for this particular topic, and it is exceptional. Another thing is direct indexing for high earners. So you know I talk about index funds all the time, but as you can see on the screen, direct indexing is an investment strategy where an investor directly owns the individual stocks that make up a particular market index, like the S&P 500. So instead of buying an index fund or ETF directly, this approach actually allows you for greater customization and tax management opportunities compared to traditional index investing. I don't personally do this, but I do know a lot of wealthy individuals that do this. There are pros and cons. Let's talk about both of those. So one of the benefits is the tax efficiency. So you can move and sell and use tax loss harvesting within a direct indexing strategy because you own all of these companies individually versus owning them all in a bucket. So you can be specific as to your winners and your losers within an index strategy. So therefore, also you have greater control and customization. However, there are drawbacks to this, of course. Higher management fees, minimum investing thresholds, and also just extra complexity that you may or may not want to deal with. Typically, you're going to need somebody to actually manage this for you to get better results. And that also comes with an additional cost. Another benefit outside of the 401k with the money that you have is real estate investment considerations like the real estate pro status. As you can see on the screen, to qualify for the rep status in a tax year, you must maintain two requirements. Number one, more than 50% of your personal services in trades or business must be in real property trades or business where you materially participate. Number two is you must work over 750 hours during the year in real property trades or business where you materially participate. Let me give you an example where people often use this. Take an example where you have a stay-at-home spouse and somebody running their own business. My situation. I also have a friend in a similar situation. However, because of the requirements, sometimes that spouse can do this, sometimes that spouse cannot do this. In our situation, given the medical concerns that we have with my daughter and the 24/7 supervision my wife has with them, we aren't able to do this and let my wife go into the real estate side. But take, for example, my friend Cody, who has no kids and has a stay-at-home spouse with a business of his own. They can utilize this rep status to offset business income, and this is one of the biggest tax hacks in the game if you know how to use it the right way. And I highly recommend you to look into real estate professional status if you're out there in this situation, or just in general, look into it because it's a very, very good tactic. So let me jump over into an example where I'm going to show you using one of my tax drawdown tool calculators exactly what this may equate to for you. So as explained earlier, I'm going to walk you through an example using my tax drawdown tool, and this is a phenomenal tool. Again, come to my DMs and ask me for it if you want it. So if you read this right here, this will give you an understanding of all of the inputs in this document, and as well as understanding the button functionality within my actual document itself. So it's very easy to go through this and to assess for yourself. And what we want to do is maximize our tax advantages here. So when I look at my entire investment portfolio, what I'm really focused on are these three buckets right here. My pre-tax bucket, my Roth bucket, my taxable brokerage bucket. And so as you can see on the screen, the input data here, the blue little highlights, is what you need to enter. So it's very easy. Your current age, your retirement goal age, et cetera, et cetera. Very, very straightforward. Now down here is your annual contributions and how much you're contributing to that specific type of account bucket. So a pre-tax 401k or pre-tax IRA could be the first bucket. A Roth 401k or a Roth IRA could be the second bucket, and then a taxable brokerage could be the third bucket. It also talks about what your current balance is, and it shows you your distribution, which automatically calculates, and your monthly contribution here. Now down here, and I'm going to zoom out a little bit and show you, it's going to give you different graphs. So it's going to show you your balance over time based on that contribution and all the stuff you just entered. It's going to show you your balance over time in today's dollars, and then your earned interest per year, et cetera, and give you a very nice little snapshot. Over here, I have all of the tax document numbers or tax numbers in 2025. So standard deduction, capital gains tax table that you're going to need. Here's a direct source to that when obviously the year always updates. And over here is a drawdown actual like breakdown. So it's going to transfer all of your input data over here. And then it's going to show you your retirement date and automatically update for you. You can always clear a calculation if you don't know by clicking this button. And this will show based on the inputs I default have in here, 2036 is my retirement year. And if I adjust this, so with this, everything here, this is all automated down here for you. So this is going to show you over from left to right, your investment balance, the investment growth that you have, how much you should withdraw or contribute. And then it actually shows you by the bucket to be the most tax efficient way possible. Roth, pre-tax, taxable. And then it shows you your three buckets of balances in those specific accounts. And then it shows your withdrawal contribution in today's dollar, the investment end balance, and investment end balance in today's dollars. And so if you want to, what you can do is obviously hit the drop down for adjust for inflation, which I would highly assume you would want to do, but you don't have to. But the biggest thing here, and what I want to show you, not just the tax tables, we have tax tables here if you need to know the numbers, all this document does everything for you. This right here is very important. So there's a reason I have my drawdown numbers $30,000 for 2025 for pre-tax, and there's a reason I have taxable brokerage as $96,700, and there's a reason I have $0 out of Roth in this example. This shows me that I'm able to withdraw $126,700 per year, tax-free, 0%. Yes, I just said that right. I am a CPA. If, in fact, you know what you're doing and how to build this bucket and each one of these buckets to a specific dollar amount so you can effectively withdraw just like this. Now, this is a textbook example. If you build your 401k balance and you only focus on the 401k balance in like a pre-tax 401k, guess what? You're only going to have this bucket. The reason our investment hierarchy accounted for the Roth as well as taxable brokerage, because if you know how to build this upward, go to the top of the mountain prepared, you can ski down the other side of the mountain very prepared and very smooth. If you get to the top of the mountain, because grandma told you to invest only in your pre-tax 401k, and you're not prepared, you don't have your skis, you're going to tumble down the mountain and you're going to hurt yourself. That's what I'm trying to prevent. So based on these numbers over here in the standard deduction, if you are a married filing jointly couple, $30,000 is the number I'm looking at right here. If you are in the capital gains tax table of married filing jointly up to $96,700, you are in the 0% level right here. This is where I want to get people to. Now, obviously, your situation might be single, you might be married filing separately, you might be head of household. But my point is, if you understand what you're doing here, you can gamify the tax code to your advantage. So the reason I selected $30,000 is because if I withdraw $30,000, guess what? The standard deduction takes my taxable income down to zero. If I withdraw $96,700 from a taxable brokerage account, again, 0% capital gains tax rate. And I can gamify this entire thing using this tool because it auto calculates for me using this. Now, one of the cool things is I have a button here outside of clear calculations. And also, as you can see here, the drawdown to zero button, which is this button right here, will show you a perfect scenario where it's going to show the exact withdrawal amounts to end with $0 at death. Now, that might not be the goal. My point is it's textbook example to show you what's possible, how much you can withdraw based on your investment contributions and assumptions you made up until this point, when your retirement year is, and then how you withdraw after the fact. And so you can see your retirement year is 2036. And if you go over here, you can start to see the contributions start to go the opposite direction. You're contributing into these different accounts, and then they start to go the opposite direction. So it's a withdrawal at that point in time. And you start to say, okay, what should I withdraw with inflation adjusted? All built into the spreadsheet for you automatically. It tells you the exact dollar amount. Now, if I adjusted this and I went to say, okay, for example, draw down to zero, you can see the numbers are going to adjust. Now, this is not a real example. I'm just throwing numbers out there to show you the benefit right here. And this is going to take you to the bottom to where you have a $0 investment balance at the end and you've withdrawn to $0 in every single specific bucket. When you know the tax code and when you know how to maximize your contributions into your investment accounts in relation to the tax code, that is when you're going to win the most. Okay, let's get back to the video. Okay, so that was a very detailed breakdown that you could utilize to your benefit. If you want my tax drawdown tool calculator, come to my DMs and just ask me for it and I'll give it to you. But to end this, I want to talk about 5 mistakes that high earners often make. Number 1, they fail to use the Mega Backdoor Roth. And as you can see on the screen from Fidelity, Mega Backdoor Roth, it refers to a strategy that can potentially allow some people who would be ineligible to contribute to a Roth account based on their income or contribution limits to transfer certain types of 401k contributions into a Roth, including a Roth IRA and or a Roth 401k. This is a great tool to use if you have access. Number 2 is ineffective tax loss harvesting. The cost of not knowing is going to cost you a lot of money. And like I said, tax loss harvesting is a huge piece of the puzzle. And the third and last biggest common mistake that high earners make is, again, back to the initial point of this video, is putting everything into a 401k with not thinking about everything else around you that you have potential to use your dollars for. And if you can use your dollars more effectively elsewhere, why would you not do it? It's usually because no one's taught you, but that's the intention of this video. So if you got value out of this video, make sure to go watch my other videos, subscribe below, and binge watch my entire YouTube today, because that's how you're going to get ahead and that's how you're going to make more money for free.